Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good morning. Welcome to Financial Issues. Today is Wednesday, July 3rd, one day ahead of the Independence Day holiday. We will have a show for you on Friday, but it won't be a rapid fire. So maybe we could kind of do a rapid fire Wednesday today. If you've got questions and you're watching during the live time, which is 8 a.m. Central, 9 Eastern time, give us a call. You'll be the first person in the call queue today. And the phone number is 610-363-1110. So what might you ask questions about? Well, if you're tuning in for the first time and wondering what it means to be a biblically responsible investor, we're happy to tell you all about how corporate America uses shareholder dollars to promote agendas that are very anti-Christ. You know, they go against our Christian values. They're supporting abortion. They're supporting or they're promoting pornography, anti-family entertainment. They're eroding the moral fabric of this country using the dollars that shareholders like you and I would invest in their company. So if you're a Christian, if you're praying that abortion becomes a horrible stain of our past that we no longer include in our culture, if you're praying that marriage stays defined as one man, one woman for life, as God said it was, if you're praying that our country has a return to its biblical foundations, then you should become a biblically responsible investor. So call and ask us questions about that. You can also ask us questions about our investment strategy, helping you to weed out those companies that are funding that dark agenda. You can also ask us about anything stewardship related, so giving, how to save for retirement, budgeting questions, things like that. So 610-363-1110 is the phone number to call. Let's get started with our stewardship verse today. It comes from Proverbs 14:26. In the fear of the Lord, one has strong confidence, and his children will have a refuge. So when we think about stewardship, most often we think about money. We think about giving. We think about, being responsible spenders and budgeters. So the scripture speaks of, that we're looking at today, speaks of confidence, security, and protection, but not in money, but is found in the Lord. So many times in the world around us, we see those with little money as being anxious and worried, or maybe in downright fear for their financial future. And sometimes we tend to envy those with lots of money because it seems as that they don't have a thing in the world to worry about. We often call them blessed because they never have to pinch pennies or rob Peter to pay Paul. We see those who are rich living what seems to be confident and carefree lives. But are we making the right connections between money and safety? Seth, what do you think?
Yeah, it's a good question, Shana. I think the answer for that is found when we realize that true security does not come from money. It doesn't come from a comfortable savings, comfortable nest egg. It only comes from God, and specifically the fear of the Lord that brings true assurance to our hearts. The wise man knows this. He knows that ultimately it is in God that he must place his full assurance. So we have to have that balance, Shana, because, we're trying to be good stewards. We're trying to work well with our money. We're trying to do all those things. At the same time, we have to anchor our souls into the ultimate source of assurance, which is God alone. Now, that kind of leads, Shana, I think, to a kind of a practical stewardship moment that we have for today, which is wondering about the cash position of the investment strategy. So, Shana, I know that some of our listeners might have questions about this, and folks, if this leads to more questions for you, please ask them. But to start, Shana, what counts as cash in our investment strategies?
Well, that's a really simple rapid fire Friday kind of straightforward answer. It's U.S. currency, dollars, money market, savings account, checking account, maybe money that you keep at home, those kind of things.
Yeah, good. And maybe to clear up some of the language here, Shana, does this include, when we think about the cash position in our portfolio, does it include the cash we have on hand, for example, in a lockbox at home, under the mattress, cash in our wallets? Or does it include an emergency account at the bank and savings? Or is this like a different bucket of money that we have to think about when we talk about our cash position in our portfolio?
Yeah, so I think it's different buckets of money.
Okay.
I think the cash that you're going to include in your portfolio needs to be investable. So, we have allocations in our asset allocation models for cash. Sometimes throughout different periods of time, they increase. Sometimes they decrease. So if this is money in your lockbox at home or in your emergency savings account, you're never going to invest that. So it shouldn't be considered part of the portfolio. And there's really two main purposes for cash. It's a medium of exchange. It's how you go to the store and buy groceries or put gas in your car. And it's also it can be a stable store of value. So, any funds that might be used in the short term, meaning like today, next week, or in the next 2 years, should really be kept in what we call cash, whether that's in your portfolio or outside of your portfolio. The benefit of the cash is that it maintains a stable value in the short term. Now, long term, we have to worry about inflation and the loss of purchasing power. But unlike other things that have been called a currency, like crypto, cash is actually a store of value or a medium of exchange. So with cash, you don't have to worry. I mean, you might have to worry long term, but you don't have to worry short term about whether the $100 that you brought into the grocery store is still going to be worth $100 by the time you get up to the register.
Yeah, it's good, Shana. And, kind of continuing with the language questions here, when we look at our cash portion of the investment portfolio, we know it's investable money. Is it something of a nest egg where we kind of have that as a base, or is it something else? What do you think about that?
Well, so a nest egg has traditionally been used to refer to retirement savings a lot of times, okay, or just, savings that you put back. And the term was really originated from the practice when farmers would place eggs, either real or fake eggs, in the hen's nest to encourage them to lay more eggs. And more eggs meant more income for the farmers. So the cash portion of our portfolio is primarily there for safety, for stability and preservation. That's an interchangeable word, and to provide a degree of margin for the more volatile parts of our portfolio. Because you often hear us say, if you have a short-term time horizon, you shouldn't invest in things that are going to be volatile, that have a long-term, that you're expecting to do well over the long term, because part of good long-term growth comes volatility, and you don't want to have to be forced to liquidate a position that's down in value, maybe temporarily.
Yeah. And speaking of volatility, Shana, what are some of the things that makes the cash position unique from the other equity-based positions in the portfolio?
Well, with cash, there's typically no volatility, right? So usually your money market is always $1. The money that you put in savings pretty much stays the same. You may earn a little bit of interest on it. So it's a little bit different for those who are taking distributions, maybe those who are in retirement and supplementing their other sources of income with their investment portfolio. It acts sort of as, the cash port acts sort of as a reservoir. So, we don't recommend that you set up your stocks to automatically reinvest. We would rather you have them pay into your cash, so it acts as that reservoir there, and it collects those dividends. That also puts you in charge of making your own reinvestment decisions. So on the flip side of that, for those who are in the accumulation phase, those who are not taking distributions, but rather trying to accumulate wealth, either by adding to their investment portfolios or, just letting it grow, it acts as an account to kind of collect those dividends, not for distribution immediately, maybe for distribution down the road, but rather as a vehicle to put you in charge of your own reinvestment decisions.
And just a quick one here, Shana. You kind of touched on this there, but how does the cash position grow if it grows at all?
Well, it only grows by the rate of interest that it is accumulating minus taxes, if it's in a taxable account, and inflation. So growth is not really a realistic expectation for cash. Yeah. Cash also has risk. I mentioned inflation risk being the biggest one. So for decades, cash paid 1% to 2% just until in the last about a year or more. And during that time, it just was barely allowed to maintain its purchasing power only because inflation was low during that decade, too. Now, a little bit of a different story. Well, I think we've got a little bit more to discuss on this topic. So when we come back, we'll finish this up. And it looks like we have a call in our call queue. So we'll get to that as well. Stick around. We'll be back with more financial issues right after this break.
My name is Valtasia. I have 5 kids total. I was basically a single mom. I didn't have an address to my name. And here it comes, that not just one baby I'm finna have, it was 3. I honestly was not gonna keep them. I had it in my mind deep down inside that I couldn't do it. I came straight abortion minded. What changed my mind was I talked to the counselor and, very encouraging. They'll also tell me, you're not going to be alone. If you need anything, reach out to us or anything. I was amazed. I definitely have a challenge of having my babies. A lot of people will ask me, how do you do that? How do you maintain? Only thing I can say is prayer. Prayer really, really worked.
To donate, just dial pound 250 and say the keyword baby, or go to financialissues.org and click on the preborn banner.
Navigating through investment options can be challenging, especially when you're determined to uphold your God-given values. Every dollar you invest is a vote for the world that you want to live in. Let your values guide your investment decisions and help to shape the culture in which we live. Become a beacon of light and pave the way with biblically responsible investing. Timothy Plan, where faith and finance collide. Before investing, carefully consider the fund's investment objectives, risks, charges, and expenses of the investment company. This and other important information can be found in the fund's prospectus. To obtain a copy, visit timothyplan.com or call 800-846-7526. Read each prospectus carefully before investing. Investing involves risk, including the potential loss of principal.
Well, thanks for joining us here, folks. Financial Issues. We're live this morning, 610-363-1110. Number to call in. We got a couple lines open, so make sure you get your call queued up right now as quick as you can. Shana and I were talking about the cash position in our portfolio in that last segment there, and we'll just finish up those thoughts here. Shana, my next question for you is when we're talking about allocation and diversification, what is a good percentage to aim for the cash position?
Well, it really depends on the stage you're at in your investment life cycle. So, you have to remember that cash will put a performance drag on your portfolio. Yeah. On the way up, if you're trying to capture upside volatility, being in cash will put a drag on that, but it will also put a drag on the way down when we have downside volatility. So that's good. It brings some stability into the portfolio. That's what asset allocation is all about. Right. So when you become a partner, when you look at our asset allocation models, we have an allocation for cash. We have some for fixed income. We have some for equities, some domestic, some international, so on and so forth. And so what we're trying to do is manage risk. We're trying to lower volatility while achieving growth all at the same time. So you have to also manage your return expectations according to how much cash you're holding. So think of it as kind of a weighted average. Let's say that you're a little bit skittish of, the market. I hate using the word market because we don't really invest in the market, but you're a little bit skittish of stocks or equities. And so you want to stay heavier in cash and maybe, like just some really stable CDs or things like that. And let's say that you want to have 20% in cash, 30% in CDs and maybe only a 50% exposure to the market. Well, you have to think of what your return is going to be as a weighted average. So people hear often that, the long-term average for the stock market has been 12%. So they think, okay, if I get into these equities, then I'm going to average 12%. That's only if you're getting 100% into equities. Most people don't, and it's really not appropriate for most people. So if you take a weighted average of that 20% cash, 30% bonds, 50% equities, you're really looking at a weighted average of about 7.6%. Assuming that cash averages about 3% going forward. It's closer to 5 right now, but it's been a whole lot lower than that in the past. I don't expect it to stay at 5. If you assume that fixed income has averaged 5% over the long term and equities have averaged, 11%, you're going to end up with about a 7.5% likely return. On the other hand, if you're willing to have a lower cash percentage, when we're talking about in your portfolio here, so maybe you only put 5% in cash, 15% in fixed income, and 80% in stocks, well, then your weighted average is going to be closer to, say, 9.7% based on those same assumptions. So, your cash allocation will be different if you're in the accumulation phase where you're adding money into your portfolio or you're just letting it grow. You're not taking distribution yet. You want to have, and you have a decent risk tolerance, you want to have a low allocation to cash. Maybe 2% on the low end, no more than 10% on the high end, unless, of course, again, your risk tolerance is really low, then you could potentially have more. If you're in the distribution phase, I like to have, that means that you're taking income out of your portfolio. So kind of rule of thumb for me is to have 12 to 24 months of whatever your distributions are going to be in cash. So typically that will translate to 4 to 8% kind of on the low end if you're in that distribution phase.
Yeah, it's good, Shana. And last question here, and this is something that we've talked about for the last several months on the show as we're looking at the economic situation here. How does the current economic climate impact our emphasis on cash, and what do we need to be aware of regarding inflation and other things like that might impact that?
Well, prior to about a year and a half ago, cash was paying less than 1% in a lot of cases, averaging, sometimes closer to 2%. But in the last little more than a year, cash has been paying 5%, even up to 5.5%. I've seen it. So, it hasn't been such a terrible thing to be a little bit heavier in cash recently. Maybe not reallocating a lot of your stock allocation towards cash, but in fixed income, fixed income's averaged 5%, if you're looking at investment grade fixed income. So getting 5% in cash or a CD has, produced some of the same results as being in fixed income long term. But you really have to keep in mind that you want to keep up with inflation. So, and it didn't do that. Even when cash was on its way to 5%, we were seeing inflation running at 9%, 7, 8, 9% for some of that time. So it didn't keep up with inflation during those times.
Yeah. Good stuff. Thank you for that, Shana. We do have a call in. We can go to the phones if you'd like. Dan from Ohio is joining us. Good morning. Dan, you're live on Financial Issues.
Good morning. Just had a question on whether I can use, or whether QCDs can be used on inherited IRAs.
They can, but you still have to be 70 and a half.
Okay, so like if I passed and my wife inherited it, she could continue to use QCDs.
No. So, and that's one of the things that you really want to focus on if you have an inherited IRA is getting that particular account lowered as much as you can, taking most of your distributions from that account, because once it passes the second time, it has to all come out.
Okay.
Yeah. So if you have large balances in an inherited IRA, I would really spend some time coming up with a strategy to lower that, because I don't know. I mean, you know what the balance is in your inherited IRA. Let's just say it's $100,000 or $200,000. When that passes on again, it has to all come out. So, and then it gets taxed as ordinary income. So think of what that will potentially do to a surviving spouse's income in that 1 year, what kind of tax bracket it might land you in.
Well, what I'm referring to is my IRA. Right now, I'm pretty much using it as QCDs. It's not inherited. It's my personal IRA. But if I pass and my wife gets it, can she continue to distribute it out in qualified charitable deductions?
Oh, when she inherits your IRA?
Yes.
Okay. So when a spouse inherits an IRA, she can do a couple of things. She could set it up as an inherited IRA. One of the reasons that she may want to do that is she's under 59 and a half and she wants to be able to take out money penalty free. The other option is that she can roll it into her own IRA. So that's going to, if you have heirs beyond your wife, that's probably the better option, is for her just to roll it into her own name, because then, she'll get to pass it on again with a little bit more beneficial distribution requirements.
Alrighty.
Make good sense?
Thank you so much. Mm-hmm.
All right, Dan, thanks for calling. That was a great question.
Dan. God bless,
Thank
brother.
you.
Happy 4th of July.
That gives me an opportunity to expand on that, just in case, maybe you're a new listener or you haven't heard us. It's something that we talk about a lot, is using these qualified distributions. And I think, this is something unique for Christians who give, who are generous, or, I guess there's a lot of non-Christians that give to causes that we wish that they wouldn't. But, there is a way to get money out of an IRA tax-free. So the requirements are you have to be 70 and a half years old, and you have to give directly to a nonprofit organization. So it has to be distributed directly to that nonprofit organization. And then kind of the third thing is that you have to make sure that you report it correctly on your on your tax return, because you're going to get a 1099. Your 1099 every year is going to show the total amount distributed from your IRA account, and you want it to, because you want the government to know that you are indeed taking out what is required of you, because once you reach certain ages, or you have an inherited IRA, you can have some required minimum distributions, and if you don't take out the amount that you are required to take out, you can be taxed 50% of what you were supposed to take out and didn't take out. So that's a big deal. But whenever you're putting money into an IRA, which so many of us have done, whether it's been through a 401k, we've saved money on a pre-tax basis because we were told that was going to be a really good thing. You don't have to, pay taxes while your investments are accumulating, and you get to make money on top of the money that you would have paid in taxes. And that is a good thing. But you have to balance that now with the notion of where we are in this country. And you have to consider, you have to ask yourself this one question: are taxes going to be lower today? Or are they going to be lower in the future? So I firmly believe that taxes are going to be higher in the future than what they are today. So the way that you're tax efficient and smart is to take the money, to control the withdrawals as much as you can from your pre-tax accounts and pay the lowest tax rate as you can. And you can't beat zero. So if you're doing your giving with your IRA once you're 70 and a half, then you get that money out at 0%. So that's a really great thing that, not everybody knows. I mean, I'm surprised a lot of times when I talk to other people in the financial advisory community, and they just don't even know about that. So it's a really good tip and trick that you can have. Well, yeah. 4th of July this weekend, or not this weekend. It feels like the weekend since we have the day off tomorrow.
Short week.
So we do have a short week. The stock markets are closed tomorrow. We won't be here live, but we have a never before seen show for you that we recorded just yesterday. So make sure that you tune in for that. The Biden administration is taking victory laps because they've released 1 million barrels of gas from the Northeast gasoline supply reserve. They're draining that reserve there that was originally established in 2014 because of Hurricane Sandy. So many people were left without gasoline. So brilliant move for the Biden administration to do that at the beginning of what is expected to be a very active hurricane season.
Brutal.
Well, folks, if you've got to leave us, we wish you a very happy 4th of July tomorrow. We hope that you will tune in and continue to listen throughout the rest of the week. For those who are listening to the full version of the show, stick around, get in the call queue. The phone lines will be open when we return from break. 610-363-1110.
Hi, this is Shana Bird, the host of Financial Issues. The Financial Issues family is so blessed to have saved tens of thousands of babies, all thanks to the generous support of you, our listeners and viewers. For $140, you can sponsor 5 ultrasounds. Please go to preborn.org, that's preborn.org, or financialissues.org and click on the Preborn logo. Save a baby, save a life.
Every time I turn on the news, I get so frustrated. When I read a headline, it's obvious they're just trying to manipulate me for clicks and views. I just want to stay informed about what's going on without all the drama and opinions. I knew I needed to find an alternative, and thankfully I found FISM News. They keep the viewers up to date with all the latest news without the extra noise. Check them out by going to fismnews.tv. That's fismnews.tv.
Remember the good old days when companies stuck to just selling their products rather than using their profits to push an agenda? When you invest in a company, you become an owner of that company. And more businesses are now using your money to fund woke projects. We're called to be good stewards of all we have, and that includes ensuring your investments align with your biblical values. Thankfully, that's where Financial Issues can help. For over 25 years, Financial Issues has stood as a leader of biblically responsible investing, encouraging the body of Christ to keep funds out of companies that dishonor God. We provide Christian investors with the tools they need to build fiscally and biblically responsible portfolios. We're at the forefront of the fight, helping you not only with your finances, but advocating for truth and godly wisdom. For more information, go to financialissues.org. That's financialissues.org.
Well, this property was actually purchased by my great-grandfather, and we were able to come back to the farm a few years back to keep the family farm, hopefully, in the family.
Working together is a lot of fun sometimes and can be very challenging.
Iron sharpens iron.
Iron sharpens iron.
We want to try to provide the freshest possible and healthiest possible produce for our neighbors and our friends and the people that we are able to touch in their lives at the farmers markets. Samaritan Ministries is a perfect fit because we feel like we can actually partner with other Christians to help them provide for their medical needs.
We're Tony and Ginger Malik, and we are Grandma and Grandpa's farm in Sparland, Illinois, and we are Samaritan Ministry members.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. July 3rd, ahead of the July 4th holiday tomorrow. Speaking of July 4th, If you remember the old line, taxation without representation, that's what really kicked off the American Revolution. And, Newsmax, Seth, you sent me a great article that Newsmax had out about taxation without representation, still a Leviathan.
Yeah, big time. So the writer of this article published an op-ed, actually a retired military member, suggests that the amount of taxes Americans are saddled with today would have had every colonist wielding a musket. I think that's true, Shana. So almost 250 years later, Americans have grown accustomed to exorbitant property taxes, sales taxes, estate taxes, business taxes, permitting taxes, to name a few. And the U.S. now runs a $2 trillion deficit annually, prints money into inflation, accumulating debt that the next 5 generations cannot pay. That's very scary, especially for us with children, Shana. We're sending money overseas without oversight for wars, while U.S. veterans can't find housing. Unbelievable. Roads are crumbling. American children falling further behind in government-funded indoctrination institutions known also as public schools. Holt notes wryly that the colonists in the 18th century behind the Boston Tea Party were ready to dump tea at between 1 and 1.5%. So they had a slim margin of error, Shana, a little bit of taxation, and they're ready to go to war over it. And we're accepting, ridiculous amounts of taxes here. It's really, really scary stuff.
How nice would it be to only pay 1 to 1.5% in taxes?
We'd be like, yes.
Oh, that would be wonderful.
For sure, yeah.
Yeah, and then also in that article, they mentioned that the size of the entire British government in 1774 would hardly even qualify to be an agency.
Oh, man.
In the swamps of Washington, D.C.
Gosh.
Yeah.
Oh, gosh. It's really crazy. I saw a tweet yesterday, Shana. It was a fellow who I follow, and he was saying something like taxation without representation was bad, but taxation with representation is possibly worse. I said yes and amen to that.
Depends on the kind of representation that
representation
we get.
In quotes for our radio audience. Yeah.
Yeah.
Crazy.
Yeah. So, we're going to talk more about taxes this coming Monday. I've invited my friend and colleague Jason McDowell back, and we're going to be talking about some of the ways that you can be tax efficient in this heavily taxed age that we live in. So that'll be interesting. Make sure to tune in there.
Yeah.
Well, the markets yesterday went up following Jay Powell's comments on inflation. He said nothing new. He said that the last 2 inflation readings signal that the U.S. is getting back on the disinflationary path again. Now, don't confuse disinflationary with deflation. Deflation means prices are going down. Although there's some very isolated pockets where we're seeing some of that, deflation is not happening. But the disinflation just means that inflation prices aren't going up as fast as they were in the past. So the 9% rate of inflation, annual inflation that we experienced last summer has moderated. So now we're down in the 3% range. He also said that the central bank, the Fed, wants to be more confident that inflation is moving sustainably down toward 2% before loosening its restrictive monetary policy. Well, I don't think that the real numbers are going to show that anytime soon. The Fed actually doesn't even believe that they're going to get even near that 2% range until late next year or really into 2026, according to their summary of economic projections. He also had added that the Fed has the ability now to take its time thanks to the country's strong economy. So that's under a little bit of scrutiny as well.
And I'm not sure what.
Now, by the end of the day, yesterday, the Dow did end in positive territory, up 0.41%. The S&P up 0.62%, and the Nasdaq up 0.84%. The pre-markets this morning, the markets are open now, but the pre-markets hovered around the flat line, tending toward the negative a little bit, as both the ADP numbers, employment numbers that we got this morning, and the JOLTS report that we got yesterday are indicating cooling in the labor market, something that we have been talking about. Now, the markets are open, and they're all slightly in positive territory. So nothing to raise the roof about, but the S&P is up almost 1/10 of a point. So is the NASDAQ. The Dow's up 0.17. So markets will be closed tomorrow, and then on Friday they will be open again, and we'll get the big government jobs report on Friday. By the closing bell yesterday, the 10-year Treasury was at 4.47. This morning, it is down a little bit to 4.4. So one interesting thing that I'm digging into a little bit is we're starting to see a market flattening of the yield curve. So the yield curve is compares the difference between the 2-year Treasury and the 10-year Treasury, and typically, you get a higher return or a higher interest rate when you take on more risk by buying a longer Treasury that is maturing 10 years down the road versus one that is maturing at 2 years down the road. But short-term rates for the last 2 years have been higher than long-term rates. So there's a lot of economists out there that say that indicates that recession is coming. So you've been hearing talk of recession is coming for the last 3 years. And what I would say is that every recession that we've had has been preceded by an inverted yield curve. But every inverted yield curve that we had wasn't necessarily followed by a recession. So there has also been all of this talk of a soft landing, and I guess that could be the case, at least for now. But folks, we have real trouble ahead if we cannot get our government to take our debts seriously. Well, the JOLTS report did show that the labor market is cooling off, but thanks to the government, both federal and state and local governments, people are still getting jobs. So, my stance is that it's not the government's job to give people jobs. That's the job of the private market. But the private markets are in competition with the government because they've just got this endless pool of money that they can tap into to pay people to do jobs, whether they're necessary or not necessary. In May, job openings, according to the JOLTS, were 8.14 million, well above the consensus we were expecting, or the experts were expecting, 7.946 million. And the job openings were above what we saw in April at 7.9. Now, the increase was almost entirely attributable to government openings. 179,000.
July 3rd. Well, corn traded both sides yesterday, but we did see some short covering ahead of the July 4th holiday. The crop is currently rated at 67% good to excellent, and that's 5% above the 5-year average and 16% better than last year. The 15-day forecast for the Midwest is really a mix of opportunities for both crop improvement and crop slippage. The next few weeks, weather is certainly probably going to drive price direction. December corn was 0.75 cents better yesterday at $4.21 and 1/4 cent per bushel. Soybean prices firmed up as a result of various weather threats to the world vegetable oil production. The U.S. crop conditions held steady at 67% good to excellent. That crop is rated 8% above the 5-year average and 17% above year-ago numbers. At the closing bell, November beans were 2 cents higher at $11.13. Higher Russian wheat production estimates and good U.S. hard red winter wheat yield reports pressured wheat yesterday despite strength from the corn and beans. Winter wheat harvest is now 54% complete, well ahead of the average pace of 39% on this date. And the hard red spring wheat crop is rated at 72% good to excellent. That's 17% above the 5-year average and a whopping 24% better than last year's crop. Minneapolis September wheat was a penny and a quarter lower at $6.31. Kansas City dropped by 7 1/4 cents to close at $5.92 1/4. Chicago was 9 1/4 cents lower at $5.81. Cotton futures has slipped a bit in yesterday's trade. At the close, December futures were 40 points lower at $72.70. In today's livestock comments, I want to take a look at chickens. Now, for the week, chicken prices are up 2 cents per bird. Income from both whole broilers and further processed birds is $5.80 per bird. You look at feed costs, grow-out costs, and processing for the average poultry integrator, and you've got total expenses of about $3.43 per bird. Leaves an estimated return of $2.37 per chicken. Agriculture is really a commodity market with low margins. You think about all the chickens you would have to raise at $2.37 to get the income that you want. Class 3 milk futures look like they wanted to test support at $19.50. We had August futures down 46 points at the close, settling at $19.61. Well, this has been Craig Haugaard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.
In a world where financial decisions can feel overwhelming, it's easy to lose sight of what truly matters. But what if there is a way to align your financial goals with your deepest values? Financial Issues has helped us navigate the complex world of finance through a biblical lens. By prioritizing and investing in a way that honors God, Financial Issues has empowered us to focus on what truly matters: our family, our faith, and our future. With Financial Issues by our side, we can invest knowing that our financial decisions are in line with our values. Take the first step today and become a Financial Issues partner to access rich online resources, training tools, and guidance for biblically responsible investing. Head over to financialissues.org and learn how to invest your money in a way that honors God. That's financialissues.org.
There are moments in life that define us. Choices determine the courses we take. Choices that create life, or those that save a life. And some make life worthwhile. There are decisions to stay or to go, to remain the same or to grow. Sometimes we pray and make peace. Other times we take a stand for what we believe. In celebration, mourning, triumph, and defeat, we are invested in every decision we seek. Despite differences, we have one thing in common: the desire to do all for the glory of God. Keep your wallet aligned with your heart and your investments in harmony with your faith. Timothy Plan, biblically responsible mutual funds, ETFs, and retirement plans. Before investing, carefully consider a fund's investment objective, risks, charges, and expenses contained in the prospectus available at timothyplan.com. Read carefully before investing.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. Hope you enjoyed the ag report there. Had a little technical difficulty on my end. Didn't realize that I ran right over that. So I'll recap what I was saying. But our phone lines are open. If you've got a question, we've got a good 10 minutes left in the show. And if you get your call queued up now, we'll get to your call. 610-363-1110 is the phone number. So I was talking about the first week of the month is always the big labor reports that come out. We get 3 of them that I like to look at. Well, I guess 4 if you include the weekly jobs numbers. But the JOLTS did indicate a cooling off. We were talking about how government openings made up 179,000 of the 221,000 that were open, with state and local leading the way. So the increase in government openings is really consistent with the annualized government employment growth of 1.1%, which is stronger than the private sector. I don't think that this is a good sign, in my opinion. It's not just the federal government that's expanding, and, hiring means spending more money that we don't have, that we're borrowing. States are responsible for a good bit of that expansion itself. So now we have government competing with the private market. And and government wages have grown faster than those in the private market. So real stiff competition there. ADP, that's why small businesses are really struggling too, quite honestly. The ADP report came out this morning, and Neela Richardson, the chief economist at ADP, said that job growth has been solid but not broad-based. Had it not been for a rebound in hiring in leisure and hospitality, June would have been a downbeat month. So JOLTS May, ADP June. Friday, we are going to get the numbers for from the BLS for May again. So the consensus is expected to be 195,000 increase in non-farm payroll, a 4% unemployment rate, which, by the way, has crept up. If you haven't been paying attention, has crept up from 3.4% in April of last year to now 4%, likely going higher. One likely cause is immigration. The Biden administration and those on the left would have you believe that we have this strong economy because we have all of these immigrants coming into the country to go to work in our economy. But more people coming into the country means that more people are jumping into the labor pool. And the government's own numbers prove that the assertion that immigrants are taking American jobs is true. According to the BLS, foreign-born employment is growing at over 2%. Native-born employment is contracting, going the other way, negative territory, at 0.229%. So, again, keep in mind that this is the biggest number that we get out all week on Friday for jobs, but it's a May number. If we look at the weekly jobless numbers for June, which won't be included in the May number that we're getting out, I'm gonna expect that the number for June is going to be even weaker. So we did get the initial and continuing jobless claims this morning as well, and they're continuing to drift upward and were expected to be higher this week, and they were. So 238 initial claims. Continuing claims were up 25,000, 1.858 million. That was higher than what was expected, and it's the fourth week in a row that we're above that 1.8 million level. The 4-week average bottomed out at the end of last year. Now, starting at the beginning of this year, the 4-week moving average for claims was right at 200,000. Today, we report that we have 238.5 million claims. So that is somewhere around a 20% increase. So expecting that employment report next month to be a little bit more realistic than probably what we're going to get this week. Well, no calls in the queue, but we've got some interaction on social.
Yeah, we do, Shana. Got a couple questions here. Robert from Texas asking the first question, is FI3 a good place to park money that's not invested?
So, yes, it can be. It depends on if it's part of your portfolio, that would be considered to be a fixed income, part of your fixed income portfolio. So you can use money there, but I would consider that to be invested. Really, money is invested no matter where you have it. I'm just assuming that he means not invested in equities. Even if you put money towards paying down your house, you're investing that in your property. So even for an emergency savings account or some short-term, some money that has a short-term time horizon, that would be a fine place to put it to.
Awesome. Marvin's up next, Shana. He's from North Carolina, 61 years old. Wondering, is there a way to give from my qualified account to a 501c3 without a penalty? What do you think?
Yes. So you're 61, so you don't have a penalty to take distributions from a a retirement account, but you do have taxes to pay. So you can do your giving from that account just like you can do it from any other account, but you won't be able to do it on a tax-free basis until you're 70 and a half.
Awesome. Next one, Shana, here's Brian from Missouri. For fixed income, is it better to buy them now as opposed to after Treasury yields and rates start to come down? What do you think?
Depends on what you're talking about. So if you're talking about just CDs and T-bills, you'll want to go ahead and establish the shorter end of your ladder now. But if you're talking about just fixed income as in the bond funds, maybe the high yield funds, what typically happens, and even on longer term bonds and treasuries, is the prices of those bonds are going to adjust downward. They're going to adjust upward when interest rates go down. So the yields should continue to remain relatively the same. So it's just hard to answer that question. I'm not sure if he's talking about the CDs and T-bills or the other type of fixed income bonds and high yield bonds.
That probably answers Brian and Kara's question as well, Shana, from Illinois. They're asking, are bonds not a good place to be invested right now? Probably the same answer for them, would you say?
So bonds have traditionally provided sort of a safe haven in a diversified portfolio when the equity markets take a tumble. So the equity markets typically have been more volatile than the stock market. And when stocks are up, bonds usually underperform, and vice versa. When stocks are underperforming or going into negative territory, bonds typically perform well. That's why they have an inverse relationship, which means that they're not highly correlated. They don't move the same direction under the same economic circumstances. So you would diversify between the two so that you buffer the volatility in your portfolio. Now, in 2022, that wasn't the case because the Fed was increasing rates. So we had equity markets that were in the negative, very much in the negative. The S&P was down 19%. The NASDAQ was down 33%. But then you also saw fixed income investments down 15 to 25%. So they had sort of a positive correlation that year, and it didn't really, being in a 60-40 portfolio wasn't very helpful to buffering the volatility. So, I don't know. I think I got off topic. What read your question again?
Yeah, just wondering if bonds are a good place to be invested right now, considering what you just said about that inverse relationship with stocks and bonds.
Yes. So, having a diversified portfolio is good. And if you're following our asset allocation models, you'll see that we still have an allocation toward fixed income, but there's a note in there. I don't want to give away too much of the partner strategy over the air. Partners, I like to protect the partner strategy. So I would suggest to go on, and I'm sure Brian and Kara are faithful followers of the strategy, so I'm sure they've actually seen that in there already. So wouldn't be a bad idea just to be more heavily weighted in the CD and Treasury part of the fixed income for now.
Nice. Last one for the day, Shana. Joe is asking, building a CD ladder, is there an advantage of choosing a 2-year ladder versus a 1-year?
Yes, there is, because the 2 years are still close to the 5% range. So as the short-term rates start to come down, you're going to extend the higher rates that we're seeing now for a little bit longer into the future. Well, I hear the music. That means we're at the end of the program. Well, I hope you have a wonderful 4th of July tomorrow. Tune in. We're going to have a show here that you've never seen before. We'll also have a special moment in history come on tomorrow evening, so make sure that you tune in for that as well. And come back on Friday. We'll have a show, and we'll be back, Lord willing, next week to remind you time's getting short. The Master's coming back. We want to help you be found a good and faithful steward of all of the assets that the Lord has trusted you to manage. Find out more about our ministry at financialissues.org.
If we ever forget that we're one nation under God, then we will be a nation gone under.